On this video, Sunday 26th of May 2013. Hope you had a good week's trading. Well, this weekend's video I want to talk about gold. We've got some interesting signals showing on the better indicators, and I want to show you those long-term charts. But before I get to that, I want to talk about market hysteria and major turning points and revisit this video post I did back in March 2010. Major turning points are always associated with extremes. We get extremes in terms of price. Price tends to move kind of parabolic. We get extremes in terms of volumes traded. The volumes traded kind of go up 2 or 3 times kind of historic averages. And we also get extremes in terms of emotions and hysteria and panic and euphoria. On our charts we can measure the price and we can measure the volume. Question is, can we measure the emotions? Can we measure the panic and the euphoria? And in this video I'm going to suggest that we actually can, using a great little tool that Google puts out. So go to your search bar in your browser and type in google.com/trends, and that will take you to this little page. Google does a great job of kind of collecting historical information on media mentions and searches and puts them together in a handy little tool here. So you can type in your search term into the top bar here, and it'll come up with a historical representation of the interest in that search term. As an example, here's the median house price as a search term. You can restrict the search by geography, so I've just put in the US as a pull down kind of menu here, and we can look back kind of 10 years, 2004. I don't think the data goes further back than that, but you can look at it by year, by month, and so on. And what you can see going back to 2004, the peak in interest in median house prices was here with an index value of 100. We don't get actual search terms or mentions and so on, it's just kind of indexed historically. And you can see May 2005 was the peak in media interest in terms of median house price, and then since then gone down in terms of interest in that search term, but that was definitely the peak. Now, as everybody knows, kind of the house price, the US housing market kind of peaked in about 2005, and house prices started to slide in 2006. And so this is a good representation of kind of the emotions in the market. The number of times it's kind of mentioned in the news, in forums, in discussions, in searches, all of those kind of things is represented by this number, this index value up here. If we go to a chart example, let's pull up the crude oil price as an example here. And let me just refresh your memory as to what happened with the crude oil price. This is the continuous contract in crude. We went above 100, we went up to, on the continuous contract price, this is over 180, where we had this peak in 2008. And you can see in terms of the Google searches and mentions and so on, the peak was October 2008, and then the peak prior to that was July 2008. If you hover over these little labels here, you can actually see representative titles of articles that were being written at the time. At this prior peak, they were actually talking about the price going up, and then at this particular kind of little dip here, they were actually talking about the price going down. And so the crude oil price kind of went into this kind of parabolic move and then kind of came down parabolically as well. So the euphoria that was being picked up in that kind of Google Trends index there is represented by the price move, and then the kind of the panic was the price kind of moving down. Next one as an example, here's Apple. So you can put in AAPL, Apple computers and so on, but just a search term of Apple, you can see there's 2 different price peaks here, or index peaks here. The first one is in October 2011, and just hovering over the C tells you that the Apple founder Steve Jobs dies is kind of representative of what was being talked about there. The next peak was in September 2012, and there we're talking about the launch of the Apple iPhone 5. Again, going to the price chart, here's Apple going back 10 years or more. And this is the little dip that we had with the news that Steve Jobs had died, and there was a weakness in Apple, and then we kind of took off from that low, and the peak was marked when the iPhone 5 was released, and price of Apple got to $700, and since then we kind of fell off. So the Google Trends is showing us kind of panic and euphoria of these 2 kind of different index points. If we then reference that with price points on the chart, we can start to see kind of the bigger picture. So let's look at the next example here. US stock market. 2 values kind of stick out here. The first one with an index value of 100 is October 2008, the bottom of the market, and then we've got another one here, August 2011. On the index chart here of the S&P 500 monthly chart, you can see 2008, October 2008 was when we had, the share market in absolute free fall. The market bottoms after that. The next kind of big decline that we have, 2011 being picked up on those Google trends, same kind of picture. So panic in the market happening there, marking extremes in price that we bounced from. Next example is US dollar index. So here we had a peak in December 2009. Again, going to the chart, shows us that was December 2009. Since then we've been bottoming around in the US dollar index and started to take off, as I see it, in the last few months. So what happens is you get these kind of panics in terms of media coverage, mentions, forum discussions and so on, and then you get a period of quiet where the price extremes kind of test where they've been. We get a little bit of balance kind of coming back into the market, and then from there, because all the weak hands have sold in this particular case, we can start to build a base and then break out into an uptrend in this particular case from there. Next chart I'm going to show you is the euro. Now the euro is a little bit messy, and I'm going to show you something interesting here. I just typed in euro into the search bar here, and it came up with these kind of three particular dates, and I thought that looks a bit odd. And then I looked at the dates of these. June 04, we get June 08, and then June 2012. And in fact what's actually going on there, when you just hover over the label on this particular last peak, we're actually talking about a football match. So this is the 4-yearly UEFA Cup happening, called the Euro. And so instead of using, just be careful, euro in terms of the term as a search term, I typed in euro rate instead, and kind of came up with these kind of extremes in terms of what the euro was doing. If we look at the euro chart going back that far, you can see again that marks kind of price points where the euro was at extremes. We were building a base, coming into a low here. We had a euphoric kind of high in the euro, followed 6 months later by a panic kind of low, then another panic low, another panic low, and so on. Each of those dates are represented by extremely high index values happening here on the trends search. Next one to look at, government bond yields. So this had a real extreme kind of peak here, November 2011, where we're talking about the yields. Let me just show you what was happening in terms of yields there. So on the chart, that was an extreme in terms of yields. We'd just gone through 6 months of massive declines where the yields were coming down on the 30-year bonds from over 4.5% down to 3%. Massive decline over that period of time. Since that kind of panic, we've been slowly kind of building a little bit of a base here, and rates look like they're kind of starting to move up at the moment. If we look at that in terms of the price chart in the bond chart, so this is at US continuous contract 30-year bonds, that low in yields is marked by almost like a left shoulder happening here in terms of bonds. We've cracked a little bit higher, but you can see in terms of the volume and interest, it's definitely kind of come off. We've got bearish divergence here happening on this long-term monthly chart on better momentum. Next one I've got is gold price. Okay, let's talk about gold. So we got two extremes in terms of the index happening here. The first one, August 2011, and then the next one at an index value of 100 was April 2013. So again, let's look at the price chart on this. What was going on with gold in those two price points? Well, the first one was the extreme in gold, just nudging up to $2,000. And the next one was the panic decline that we've had over the last couple of months. So about 7 or 8 weeks ago, all those, we dropped through 1600 as a support ledge, took us into downtrends on the weekly and the daily charts, and that kind of move down, that 20% move down in gold was accompanied with extreme mentions in terms of what was happening on the internet, media mentions, and so on. So you can start to use this Google Trends kind of tool to measure those euphoric and panic kind of points in a marketplace. As a final couple of examples, I'm just going to show you here's silver. And silver here, we've got an index value of 100 in May 2011. So just show you the silver price. That's May 2011, where silver almost got to $50, just under. And again, you can see the extremes in terms of better momentum here with exhaustion buying going up into those highs, kind of showing that kind of euphoric kind of peak happening. We haven't had a similar kind of euphoric or a panic type reading yet in silver here, the current kind of decline that we had a couple of months ago was marked by an index value of 60 on Google Trends. But in terms of looking at the price charts, I look at gold and silver together. They tend to travel together. Silver was early in terms of the peak in silver. Gold peak kind of happened later. What we're seeing kind of with the lows in gold at the moment, potentially gold is signaling a little bit early possibly compared to silver. So just kind of have to wait and see. Then the last example I've got here is Japanese yen. And you can see at the moment we've had massive decline in the Japanese yen. In the last 6 months we're down 30% in the Japanese yen versus the US dollar. But it's interesting that the readings that we've had in Japanese yen over the last couple of months, they reached an index value of 85 right now. We've not kind of hit these kind of historic kind of peaks at 100 yet on the Japanese yen. So the largest value we've had in the Japanese yen so far has been March 2011. The index value was 100 there. So let me just show you what's happening on the chart. There's March 2011. So you can see the yen kind of, it certainly spiked at that point, then spent a little bit of time kind of testing those highs, going a little bit higher before falling off. We've had extreme selling in terms of better momentum, but in terms of the media mentions in the yen, not quite yet in terms of a bottom being made there.